Welcome back. It's time now for On the Radar, where we ask an investing professional what they're looking at in today's markets. We're back with Colin Cieszynski again. He's at SIA Wealth Management. He's the chief market strategist there. This time, Colin, to talk about gold and whether it is reasserting its role as an inflation hedge. We're still not at $2,000 per ounce. That's the price that many gold watchers thought gold would achieve and maintain this year. We're still not there. Why not?
Why not is that, I mean, we got pretty close earlier this year, but there's three main things that kind of drive gold over the short term. One is, of course, that gold is the natural, I call it the nemesis of the US dollar. Usually when one's going up, the other one's going down. The second thing with gold is it tends to be sensitive to if there's any kind of a crisis in the financial system, gold tends to go up, or sometimes a crisis in politics as well. And then the third one is gold has a natural role as an inflation hedge. So when we look, the last time gold got to 2,000 earlier this year was during the banking crisis, when the health of financial system was being called into question. And then over the last few months, that's kind of gone away. The central banks and governments were able to act quickly enough that they avoided the contagion this time. So gold has kind of come back off a little bit. And
we have seen some strength recently in the U.S. dollar. The U.S. dollar, as measured by the Dixie Index, which is that basket of international currencies, the dollar spent much of the past year declining. Quite recently, it has picked up some strength as the Fed has continued to boost interest rates.
Absolutely. So the Fed has continued to raise rates, and they're pretty much higher than most of the other major central banks right now, and everybody else now, even the Bank of Canada, is playing catch up. And then last week, of course, we had what we call the hawkish hold, where they did pause on interest rates, but then they signaled, well, we might get 2 more rate hikes this year, whereas previously that 5.25 had been the level they thought where they'd be done. So that was intriguing. That pushed the U.S. dollar up a little bit, and that's what flagged me on gold, because we had a couple of days where the U.S. picked up, the dollar picked up on the Fed, but gold actually held up reasonably well too.
And there we see that strength in the U.S. dollar. So certainly the trend over the past year has been negative, but you can see in much of May, the greenback gained some significant ground against that basket of international currencies. Gold investors have always have the choice between investing in the commodity, and there's numerous ways to do that, to invest in gold, the metal, or in the gold miners. Any thoughts on the recent performance of the gold miners versus the metal itself?
It's been pretty similar. When gold took off earlier this year, the miners did as well, and as gold has come down, they've kind of been more trading in sync or in tandem of late.
And what about silver? Silver often tracks along with gold.
Agreed, and generally, I call them fellow travelers. They tend to move in the same direction, although silver tends to be a little more volatile on a percentage basis.
What role is there for gold in an investor portfolio in terms of a weighting, do you think?
Well, there's room for it. I mean, the thing that you tend to find with it is that it's countercyclical. It tends to do a little bit better when the markets are getting in trouble, and then when markets are doing well and there's confidence, and gold tends to not do quite as well. They either sometimes they go down, sometimes they lag. At the moment, we've kind of got the gold price hanging around in this 1960 to 2000 area, and it's just kind of hanging around the lower part of that range right now. And the reason I think that is back to inflation. So if we ruled out that it's not the U.S. dollar supporting gold, and it's not the health of the financial system supporting gold, then that leaves the third one, which is inflation. And the most important thing we've seen coming out of central banks, whether it was the Fed, the Aussies, the Bank of Canada, even the Europeans were, and 3 of which did raise rates this month, was inflation is holding up. Inflation has been sticky. And while commodity price inflation has come off, the wages and the services inflation has held up more than central banks had wanted to. And that's why they're now hawkish holds and raising rates again. And it's interesting because now this week we have another round with the Bank of England and the Swiss National Bank on Thursday.
Investors hope that we're close to the end of the interest rate hiking cycle, and then central banks will get inflation under control. We're not there yet, but given the fact that the market is a forward-looking mechanism, how will gold respond if there are clear signals now that the rate hikes are over and that inflation is tracking sustainably downward?
At that point, I would say we'd probably continue to struggle with that 2000 level that we have in recent months, unless something comes out of left field.